What is your debt to income ratio and why does it matter? Here's the thing, the lenders use the debt to income ratio as one of the primary factors on whether to approve your loan or not. So let's get into it. Some of the basics are the debt to income ratio has two factors, a front ratio and a back ratio. The front ratio is your total housing obligation divided by your gross income. So that is called your front end DTI. That front end DTI typically is your full PIT payment, your HOA or condo dues, your total housing divided by your gross amount of income. So if your payment is total of $3,000 and you make $10,000, you have a 30% front end ratio. Okay. Your back end ratio is your front ratio plus all of your other debts that are required to be counted against you off your credit report. Car payments, student loans, uh, credit cards that you roll, all of those go into the back portion of your ratio. So if your car payments, student loans, and all that add up to be $1,000, and you had $3,000 on your front for your housing, you have $4,000 total debt to income divided by 10 equals a 40% back ratio. Here's the thing, lenders like to see the front ratio in between typically 28 and 36 and the back ratio between 36 and 50 depending on the program. Fannie Freddie says 28-36. Okay, so ideally that's really where they would like you to be. All right, but the conforming loan limits typically will go up to a back ratio of 50, so or 49.99. FHA with compensating factors, I've seen it go as high as 56. And on VA loans, there's technically not a debt to income number that is a gauge. They look at how much residual money is left over after paying all the bills. They have a minimum number, and if you're greater than that, typically you can get a loan approved. Tips to lowering debt to income ratio, you can refinance high interest rate loans. You can extend out the term on an auto loan and lower your payment. You can roll credit card debt over to a zero credit card, zero interest, and lower the payment that way. You can also lower your installment debt down to 10 payments or less. Doesn't go into your debt to income ratio. That's a pro tip. So you can buy more house by just getting that under that 10% limit. So that is your class on debt to income ratios. The lenders use that to say yes on your loan or no. So it also allows you to, if you have lower back end, okay, allows you to roll some of that into the front end and buy more house. So controlling your finances, having no debt is your best scenario to expand the purchase price that you're eligible for. My name is Kevin Retcher. I'm the owner of First Meridian Mortgage. This was your debt to income class. If you have any questions, give me a call, 703-799-5626. Happy to serve you. To all the Marines out there, Semper Fi. I'll talk to you soon.